Let me tell you the laziest money move in history. You take $8,000. You put it in one specific place. You do absolutely nothing. You don't check it every morning. You don't obsess over charts. You don't follow the news. You just leave it alone. And 30 years later, you have $632,000. But here's the part that should stop you cold right now. You only put in $8,000. That means more than $624,000, almost 80 times your original money came from money-making money. You didn't earn it. You didn't work for it. Time did. And here's the craziest part of all. More than half of that $632,000 appeared in the final 10 years alone. The first 20 years? Barely a ripple. The last 10? An avalanche. In a moment, I'm going to show you exactly which single year creates more wealth than the previous 20 years combined. But first, the lazy method itself, because this video's title is a promise, and I'm keeping it right now. The lazy method is this. Put your money into a low-cost S&P 500 index fund, and then ignore it for decades. That's literally it. So why does almost nobody actually do it? That's what this entire video is about. And by the end, you'll understand something about your own brain that Wall Street has quietly been counting on for decades. Let me introduce you to two people, Sam and Alex. Same age 25, same job, same paycheck, same $8,000 saved up 1 month. Sam sees that $8,000 and does what most people do. A vacation, $2,000. Gone. A new phone, $1,200. Gone. Some new clothes, a few nights out, a gadget or two. Gone. Normal stuff. Totally relatable stuff. But here's what Sam never saw on the price tag of that vacation. It didn't cost $2,000. It cost him $632,000. That phone wasn't $1,200. It was hundreds of thousands of dollars. Every single one of those purchases, made at 25, carried a hidden price tag that Sam never saw because nobody ever showed it to him. And by the time he's 55, working harder than ever, wondering why money always feels just out of reach, those receipts are long gone. But so is the $632,000. Alex made a different choice. Same money. 20 minutes of her time, one account, one fund, one decision, and then she got on with her life. Now I want you to guess something. Quick mental quiz after 20 years. What do you think Alex's $8,000 has grown to? Take a guess. Hold the number in your head. Because the answer is going to surprise you, and not in the way you're expecting. Here's how most people imagine investing works. You put money in, you earn interest, you earn a bit more. It's like adding bricks, slow, steady, predictable. But compounding doesn't work like stacking bricks. It works like a snowball rolling down a hill. And this is where it gets psychologically dangerous, because the first half of the hill looks completely broken. Let's follow Alex's $8,000 at 10% average annual return, the S&P 500's historical average over 100 years. Year 1, $8,800. She made $800. Underwhelming. Year 5, $12,884. Year 10, $20,750. Now remember that number you guessed earlier? For year 20, here it is. Year 20, $53,800. If you guessed higher, you're not alone. Most people expect investing to feel more impressive by year 20. But it doesn't. Not yet. And this is the moment right around year 8, 10, 12, where most investors quit. It feels slow. It feels pointless. It feels like the thing isn't working. They pull their money out. They put it somewhere else. They give up. and they never find out what was waiting on the other side. Because watch what happens next. Year 25, $86,700. Year 30, $139,000. Wait, but I said Alex ends up with $632,000. Where's the rest? Here it is. Year 35, $226,000. Year 40, $362,000. Year 43, $508,000. Year 45, $632,000. Do you see what just happened? Alex's money sat at $53,000 at year 20. In the next 25 years, it grew by nearly $580,000. The first 20 years added $45,000. The last 25 added nearly 13 times that. This is the snowball, small and invisible at the top of the hill, unstoppable and enormous at the bottom. And now I need to show you the single year that creates more wealth than the previous 20 years combined. Here's something that breaks most people's brains when they first see it. In roughly year 38 or 39 of Alex's journey, a single calendar year adds more money to her account than she earned in her entire first 2 decades of investing. 1 year, more than 20 years of growth, combined. How is that possible? And more importantly, what does it mean for someone who thinks it's already too late? Stay locked in, because what I'm about to show you next completely changes the math for anyone starting late. Here's the truth that no one in personal finance wants to say out loud. The stock market isn't your biggest enemy. Inflation isn't your biggest enemy. Bad luck isn't your biggest enemy. Your own brain is, and it's not your fault. You were literally born this way. There's a wiring in the human brain called hyperbolic discounting. It means your brain is hardwired. Biologically hardwired to choose things that feel good right now over things that are massively better later. $100 today feels more real than $100 next year. And $632,000 in 30 years? Your brain barely registers it as real at all. It's just a number. It's abstract. It's fake feeling. But that vacation, that phone, those feel real. They feel now. So your brain keeps choosing now. Every time. Without asking you. Without telling you. Just quietly steering you away from your future self one impulse purchase at a time. And then there's a second trap. Researchers call it the planning fallacy. It's the reason every person you know, including you, has said at some point, "I'll start investing when things settle down, when I earn more, when I have more time." But here's the brutal math of waiting. If Alex had waited just 5 extra years and started at 30, instead of 25, she wouldn't have $632,000. She'd have about $389,000. 5 years of waiting cost her $243,000. That's not a small gap. That's a car. That's a down payment. That's years of freedom gone because of 5 years of not yet. Now here's where it gets interesting. The greatest investor alive, Warren Buffett, has publicly said that when he dies, he wants 90% of the money left to his wife, placed in a simple, low-cost S&P 500 index fund. Not hedge funds, not private equity, not some complex strategy. A simple index fund. Think about that. If the most successful investor in modern history believes the average person's best strategy is to buy one simple fund and stop thinking about it, maybe investing is a lot simpler than Wall Street wants you to believe. Quick thought experiment before we go further. 2 investors. Same $8,000. Person A invests it at 25 and never adds another dollar. Person B waits until 35 but adds $200 every single month. Who ends up richer at 55? Hold that answer in your head. I'll give you the result in about 2 minutes, because the answer will make you rethink everything about how timing and consistency actually work together. Okay, so here's the actual lazy method, not the concept, the literal steps. Step 1. Open a brokerage account. In the US, that's something like a Fidelity, Schwab, or Vanguard account. Takes about 15 minutes online. Step 2. Find a low-cost S&P 500 index fund. Look for something like VOO, SPY, or FXAIX. These hold tiny pieces of the 500 biggest companies in America. When the economy grows, and over the long run, it always has these grow. Step 3. Put your money in. Set up automatic monthly contributions, even if it's small. $50, $100, whatever you can. Automate it so it happens without you making a decision. Step 4, and this is the hardest one. Leave it alone. That's the entire method. No charts, no daily checking, no panic selling when the market drops. Just leave it alone and let time do the work. Now the answer to that question I asked you. Person A invested $8,000 at 25 and never added another dollar. Person B waited until 35 but invested $200 every month. After 30 years at age 55, Person A has about $139,000 from that original $8,000. Person B has contributed $24,000 of their own money over 20 years and has about $152,000. They're almost equal. Person B put in 3 times more of their own money and barely kept up. That's the cost of starting late. That's what waiting actually buys you. But here's the uncomfortable question nobody asks. If this is so simple, if it's literally 4 steps and a little patience, why do so few people actually do it? The answer isn't laziness. It isn't lack of information. It's something much more specific. And it's the one thing you need to eliminate from your financial life before any of this works. The thing that kills most people's wealth isn't a bad investment. It's a normal Tuesday. It's the random Tuesday when you're bored and you buy something you didn't need. The Tuesday you tell yourself, next month I'll start. The Tuesday you check your portfolio during a market dip and panic sell everything, wiping out 3 years of gains in one afternoon of fear. Wealth isn't destroyed in crashes. It's leaked away one ordinary day at a time. Sam and Alex didn't just make different financial decisions. They made different decisions on regular, boring, forgettable Tuesdays. And 30 years later, one of them is staring at $632,000 they barely had to think about. The other one is still waiting for the right time. Let's go back to that number one more time. $8,000 in, $632,000 out. $624,000 created by time. Not by talent, not by luck, not by working harder. You don't need to be smart to do this. You don't need to be rich. You don't need a finance degree or a stockbroker or a perfect moment. You need 20 minutes and the ability to leave something alone. 30 years from now, the version of you sitting in that chair will either look back and say, "Thank you," or spend a decade wondering why you waited. The difference between those two versions of you is a decision that takes less time than ordering food on your phone. The account doesn't care how old you are. It doesn't care how much you make. It doesn't care about your past. It only cares about one thing. When you start,